Your market news now. Asian markets saw a sell-off led by technology firms. This on fresh concerns about demand for Apple's iPhones. Meanwhile, Japanese car giants Nissan and Mitsubishi plunged on news that their chairman, Carlos Ghosn, had been arrested over alleged serious financial misconduct using company resources for his own personal end. Over in Japan, the benchmark Nikkei share average declined by 1.1%. Hong Kong stocks were hit even harder, the Hang Seng Index falling 2%, and mainland China saw losses around a similar ballpark, the Shanghai Composite Index losing 2.1% at the close. Over in the United States, stocks dropped on Monday as investors dumped Apple, Internet and other technology shares, further shaking confidence in a group of stocks that have propelled the long bull market. The Dow Jones Industrial the Dow Jones Industrial Average fell by 1.56%, the S&P 500 lost 1.67%, and the Nasdaq Composite fell a whopping 3.03%. Well, it's a down day on the local equities market, with tech heavyweight Naspers also down by about 4% today. All major sectors appear to be down with the exception of the gold mining counters. The local currency is also losing some value today. Let's take a look at the indicators. Well, for more on the markets, I'm joined by independent analyst Chris Gilmore. He's standing by for us at our Johannesburg Stock Exchange studio. Thanks very much, Chris. As always, markets looking rather wobbly, and it seems as though the tech counters are the ones that are leading the charge downwards. Are there any other factors as well at play?
Nompo, good afternoon. I think there's a lot of factors out there. First of all, you touched on it briefly in your preamble. This is the longest bull market in history. I mean, we're talking about something that started in March 2009. So, it's kind of running out of steam. You can't expect anything like this to last forever. Secondly, Goldman Sachs put out a report yesterday suggesting that the US economy is going to, in their words, grind to a bit of a halt by the third and fourth quarters of next year. They're still looking for reasonably robust growth in the first and second quarter, but tailing off in the third and fourth quarters of next year. So I think that gave a bit of a fright to the markets. And then if you look at the tech stocks, to the ones you were talking about, both Apple and Amazon in bear market territory. In other words, you're looking at more than 20% down from the recent highs, which was as recent as, I think, October. The Apple iPhone, I think people are getting a little bit disenchanted with it. I mean, the days of Steve Jobs are long gone. You know, when every time he came and gave a presentation, there was always something new. It's difficult to think of what they can come up with in terms of innovation at Apple. But for Apple and Amazon and quite a few other tech stocks to be down of this order of magnitude, and especially Apple, given that it's not on a particularly demanding PE, I think it's telling you that there's a lot of problems, incipient problems in the US. So you put it all together, and more and more observers are now talking about recession in the US in 2019 and in 2020 at the earliest. I don't quite buy that, but I think what we are looking at now is a big reduction in growth from these kind of levels. And following on what happened in the midterm elections last week, I think Donald Trump's ability to further stimulate the economy with more tax cuts is going to be severely limited. So we can't really look to the US to provide the lead in either the economy or in markets as we have for the past few years.
Every so often, when there have been headlines about Mr. Trump and so on, people have fled into safety, into the US dollar, Swiss franc and so on, and gold, for example. And emerging markets like South Africa have got stuffed. So given what you say about the predictions for the US economy, could there be a silver lining and perhaps emerging markets become the favorite of investors looking forward, basically, consistently so, not in and out of emerging markets?
Well, I think there could, Nampu, and given the fact that you talked about what's been happening in our markets this morning, and there's been a bit of a bloodbath there as well. But that's mainly because of a big tech company called Tencent, Naspers. That's taking a bit of a hit this morning. And because Naspers is such a huge component, 20% plus of our index, I think we would otherwise be experiencing a bit of a rally here, but were it not for that. So I think you're right. I think, at least in the short term, one can expect to see a bit of a move back into emerging market stocks. And you're seeing that already reflected in the relative strength of the rand. I mean, the rand is flirting with the 14 rand to the dollar level already. It's around about 18 something to the pound, just over 18 to the pound. And even against the euro, it's looking quite strong. So yes, I think if we use the rand as a proxy for emerging market currencies and thus economies, there is a bit of a movement back into emerging markets, as many other commentators would refer to it as risk on.
Chris, I remember a couple of years ago when the Brits were voting on Brexit, we invited you in studio and you came here proudly in your Scottish regalia and you had a lot to say about the process. Now, things are looking very, very dodgy for the British right now. It looks like they're going to go through with a hard Brexit. What's the big deal? Just explain to the viewers why it would be a problem for them to experience a hard Brexit where they just leave without any deal.
You know, they've had 2.5 years to try and go and establish new deals around the world. I mean, they're leaving a 300 million strong economy, a frictionless economy, to go in favor of this brave new world. And the Brexit Trade Secretary, a fellow called Liam Fox, has been singularly unsuccessful in establishing anything more than a couple of deals with New Zealand and a few other places. So that's the first point. Look, I have no doubt that they will strike other deals according to World Trade Organization rules, but those won't be, as I said, they won't be frictionless. There'll be a lot more strings attached to them, and at this point in time, when there's a lot more protectionism around the world, it'll be increasingly difficult for the Brits to go and do what they think they can do. Theresa May, unfortunately, painted herself into a corner from the very beginning by saying they're not going to be in the customs union, they don't want to be part of the single market. So, I mean, what did she expect in terms of the reaction from the Europeans? In terms of a no deal, I think that's increasingly likely. May herself, her position is looking increasingly parlous. Not just from the point of view of her own party, where there's a bit of a revolt going on. I don't think that's going to materialize into much more than hot air, frankly. They have to get 48 people, 48 backbenchers signing up to foment a vote of no confidence, and I suspect that's actually not going to happen. Of more import is the vote in Parliament on the 12th of December. The deal that she's put forward probably isn't going to go through. There's a lot of resistance against it. So if that doesn't go through, then you're left with less than 3 months, well, a fraction more than 3 months to cobble together some kind of deal. And this plays right into the hands of the Europeans. The last thing they want is for Britain to leave. I mean, they don't like the Brits, but they don't really want them to leave either. Because it kind of sets a bit of a precedent. Yeah. So I think the likelihood is they will crash out without a deal, or at best a really a poor deal. And it means they're going to have to start from scratch, because even in terms of World Trade Organization rules, they're not going to have an easy time of it. 2 or 3 weeks ago, they were told quite categorically by the WTO that no, you don't come in where you think you're going to come in from. You're going to have to start from scratch, Brits. So it's going to be incredibly tough. I think the UK economy is going to suffer, and this is all self-inflicted. They really didn't need to do this. And by the way, this is on a vote of 42 to 48. If that isn't something that's saying we really don't know, it's highly divisive, and I really don't know what goes on. I suspect the chances of another referendum taking place are growing by the day.
Chris, I'm going to interject there.
The question to the people, is this what you really want? And perhaps common sense and sanity will prevail. Okay,
Chris, you have been in the journalism fraternity, so you understand when I have to cut you off. But thank you very much for your insights, as always. That was Chris Gilmore, independent analyst, just giving us his take on what's happening with the markets. More business news for you after a short break.